Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How are you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your RIA, call your broker. That's what they're there for, to give you advice, provide you with guidance.
Couple housekeeping notes. Mike and Jim were nice enough to mention the doctor's doing a show. Jake is doing a show on Friday after the morning show. So he did mention, and there was a lot of commentary yesterday. This is the second part of the discussion about the individual we had on at the end of the day. And he's come in a couple different times. Yesterday's show, I apologize that, particularly to you, D, because it was a tirade of negativity and bad attitude, basically. And it's hard to judge. So going forward, I mean, we have a strong community of people who come in. To go live, it's going to have to be someone who I really know or get to know through the chat. I mean, we have enough people asking questions from the group of 50 to 100 regulars who are on. Who really want to have real questions, and people can still come in and ask questions, email, and listen. The gentleman who was on yesterday, if he had a point he wants to make, email support at Market Chameleon. Dimitri and I will look at it. We can do things to this. If you have something to add, but the negative name calling was just not of value. So. Going forward, and then actually we got a bunch of emails asking for this from Chameleon users, and it happened. Jake, who's coming on, actually watched yesterday's show, and was one of his comments was he doesn't want to. He's coming on. He's not. No one's paid, so he's coming on just to show how he uses Market Chameleon, and everyone uses it differently.
Right.
So please be courteous when you're on. This is. Not something we have to do. We debate internally whether we need to do. It's something we're trying to help people, use the site and navigate themselves around the site. We are not here to give you advice on what you should be trading, or we're trying to display the data and have a platform to use the data. So
yeah, and I do want to say thank you to everybody, because I got really good emails yesterday, saying in our support, and why this is just a heckler, and not to actually, almost all the emails we got just said not to let this individual in any longer. But if you are joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions that you may have about the Market Chameleon tools, the data, or the analytics. And if you do have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read it back to me. We do provide a link to Zoom that you could click on. If you go to Zoom and click on raise your hand, we let you in. You could ask your question live and direct. We never know what people will ask. So we're not, we don't pre-screen it. We just kind of let you in. But if you do have a question, and you want to come in, just please be courteous, because there's other people out there also listening, interested in the conversation to add value. So we're gonna try to keep that open, but we don't want people coming in just to be rude. So with that, I'm going to share my screen, and while we give a couple minutes for more people to join us and for questions to come in, what we'll do is take a look at the pre-market report, see if we could get some insights on what's trading at pre-market hours, and then we'll go to the questions.
Perfect.
Okay. So this is the pre-market report. These are stocks that are trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. So far, I got 31 stocks that made our percentage gainers list. Let me just refresh this. May have had this up for a little while. So in this list, these are stocks that have to meet certain thresholds that we set with volume, price, liquidity, and so far we see that 34 stocks made our percentage gainers list, 28 on our decliners list. So from this perspective, we see a little bit more bullish sentiment in the pre-market trading. If we go up to this calendar view, this gives us a summary of what's going on in a pre-market hours from a high level. So today we're September 6th. We have 324 stocks that are trading higher than yesterday's close, and we have 334 stocks trading lower than yesterday's close. As far as volume or number of shares, we have 90.8 million shares trading on up volume versus 44.7 million trading on down volume. And if we convert that volume into dollar value, we got $592 million worth of stock trading higher versus $1.4 billion worth of stock trading lower. So that's more of a mixed bag and mixed signals, because if we look at it by dollar volume, there's much more shares that are trading lower. But if we look at the stocks, just the number of stocks, it's kind of evened out. Okay, so we could go down below and look at it from another perspective, or from a different angle. And if you notice that on this list, we have small cap stocks, we have ETFs, we have closed-end funds. So any security that's traded on the major U.S. exchange, if it's trading in pre-market hours and meets our thresholds, it can make this list. And to narrow down this list to a smaller group of stocks, we could use the filters here above. And if you have a watch list, you can filter by your watch list. I'm going to use this one in ETF filter. If I click on it, you get a drop-down menu to select from. I'm going to select SPY, which is the S&P 500 ETF. And when you do that, the list below will get filtered by stocks that are holdings in the SPY. So here we have 3 stocks that made our percentage gainers list and 5 on our percentage decliners list. So maybe slightly bearish bias in a pre-market trading, but I would say it's kind of mixed bag, so pretty evened out. I guess if we have questions, I'll just go to the questions now. We gave them a couple minutes.
Nothing's popped up.
Okay. Let me continue on the end of yesterday, the thought. So we talked about when we started out on the covered calls. And let me just bring this up here. We started looking at historical data that showed how a particular strategy done over and over again, how it performed, right? So the percentage of times that it was profitable, the percentage of times it was unprofitable, and then we took the average returns. And part of the question through the email was, how do I track my cost basis, from the moment I bought it? And so I started getting into, when we look at these stats in particular, these are measuring simple returns. And this is an important concept in finance, that simple returns themselves, they're not additive, okay? So I showed, and this is where we ended up. So as an example, if you start out at $100, all right, let's say the stock is $100 and it goes up 10% on the day, it ends at 110, right? So if up 10%, it ends up at 110. So the next day, it starts at 110. If it's down 10% that day, then the stock ends up at 99. So you're below the 100. So you could see that if I add daily returns together, just daily simple returns, in this case, they would add up to 0, plus 10% minus 10%. But in actuality, you're down 1%, right? From 100 to 99. So it isn't this is an important concept in finance, right? And where it goes to, not just in the analysis, because this is in a lot of financial models, you get the Black-Scholes model, they'll use log returns, but this is important also when it comes to hedge ratios. Because what if I did want to create a strategy, right, that did capitalize on daily returns, right? What if I was interested in that? You could do weekly returns, daily returns. You could trade seasonality, earnings. But what if I did want to trade those periods, those returns? So how do I do that? And it's a concept of either dollar neutral or notional neutral, right? So how would I come out to break even here? Right. So how would I do that? Well, if you start out at 100, and let's say you invested $1,000, all right, at the beginning of the day. Well, by the end of the day, if it's up 10%, right, you have $1,100 worth of stock. Well, to maintain that $1,000 neutrality, right, dollar notional, you have to sell $100 worth of stock to get back to 1,000, right? So you're resetting at every end of period, you're resetting back to dollar neutral, dollar notional neutral, right? So what about in this situation? You start out at 1,000. Well, if it's down, right? If it's down 10%, well, now you got less than $1,000 worth of stock. To get back to 1,000, you have to buy more stock, right? And this is how hedging would work it themselves. So imagine if you're trying to trade a pair strategy, right? You figured out your hedge ratio through your beta. Well, at the end of each period, you would have to get back to dollar neutral, meaning that wherever it's settled, if your bet resets each day, you got to go either buy more stock or sell stock to get back to dollar neutral. Okay, so it's an important concept to understand, especially once you start hedging and once you start pairing off or trading, things that you're spreading off. All right, so that was the point I was trying to make. So getting back to this, when we were looking at these stats, what this was trying to do was say, if you're doing a covered call strategy, right, and you took a particular option, right, you'd like say with the number of days to expiration, and you pick the delta of the option, which would be here 34 delta. The question we were trying to answer with the analytic is, if we look back in history at a similar option, basically it'd have to have the same days to expiration and similar delta, how did that strategy perform, right? So we grabbed the observations, we found 21 similar situations, for example, in this EBIX. And in those 21 observations, we kept the stats. Here, I'll load them up. So you could see here, these are the stats. So it goes back in time, says here would be the start date for this first observation, July 25th. This option that we were looking at would have 18 days to expiration. So they all have 18 days to expiration. This had a delta of 34. So remember, it's looking at the closest delta to mimic this strategy. And here would be the bid and the offer of the call. So this is assuming if you did the buy right on the bid. Okay. This is the underlying stock. So this is when this expired. And based on the expiration, you could see where the stock was. So in this case, the stock moved from 28.20 to 13.91. And this tells you the return on the strategy. And then it compares that to the return if you only did the stock. So why we have to reset it is because you could see here that you have all these different percentages, right? So all these different percentages, if we took the average of them, right, because you have to add them up and take the average, it would assume that your dollar risk at each level would be the same, right? So if the stock was higher, you would adjust it. And with the stock's lower, you would adjust it so the dollar value that you had at risk would be the same. Right. So that was the point that I was trying to complete yesterday. So any questions with that, Will?
None have Jackie, no questions with what you just discussed. It's a question about unusual option activity that popped up.
Okay. Sure.
Jackie's asking, if I found a high unusual option activity on one stock today, but at the same time, the stock also already moved a lot, is it wise to buy a call or a put on the stock and wait? Or he's asking, I guess it's unusual option that he views as bullish. Is it wise to buy a call on a stock or wait for a pullback?
I mean, that's
Actually,
huh?
Robert answered the question how he would view it there. I mean, that's each individual that has to make a trading decision, right?
Right.
Based on things they've seen in the past and the way the stock has moved. So.
Yeah, there are too many factors that go into play to make that individual trade. I don't think there's like a one rule fits all in that situation, and each instance, could be very unique.
Yeah, and Rob actually made a good point.
It
It may not just be buying a call, right? If he mentions a credit spread, there are other things to do and look at based on something you found.
There are a lot of different ways to approach that. So I wouldn't be able to, just give a straight answer. But if you had a unique situation you wanted to look at, and something specific, then we would take a look at it. But I think that would be it's too general and too many factors that come into play.
Excellent.
Okay. So the only other thing I know that we had an email regarding this historical price return distribution, which gives you the ability to enter in a stock and let's do it this way. Here we have an IWM. You could pick a different methodology for time period. So let's use intervals. Okay. And in the intervals, you could pick when you want to look at certain returns over a time period, let's say 2 days, 3 days, 4 days, 5 days, or we could even there over a 5-day period. And then we use 4 years of data. We could run that. And what this will do is go back in time and calculate over 5-day periods, right? How did this stock perform or tend to do? And then it gives us some stats. So over a 5-day period, did it tend to go up more often, go down more often, pretty even? If we took the average, right, or the median returns. So here we see 56% of the time in the last 4 years, the stock was higher at the end of the period, right? Any 5-day period, 44% of the time was lower. If we took the average, remember we were talking about the average, it's based on resetting and always saying dollar notional. On average, it gained 0.21%. The median return was 0.38%. So the difference between the average and median is that the average can get pulled one way or the other because of outliers or something's weighted more towards the upside or downside. So the median's that middle return, or the 50th percentile. Then if we separated all the moves, if we separated just all the up moves and all the down moves, then we could compare, compare those percentage moves. So we could see here that if we took all the up moves, on average, they were 2.6%. If we took all the down moves, all the negative periods, on average, it was 2.86%. So this tells us that when it was down, right, the magnitude of the down moves outweighed the magnitude of the up moves. So it's a little bit more volatile to the downside. But that was offset because the up moves were much more frequent, right? 56% of the moves were up. If we took the max moves in that 4-year period, we see that the biggest move to the upside was 15.1%. The biggest move to the downside was 17.3%. Okay, so this is kind of giving us those large, outlier moves. How big were they compared to each other? So this is starting to paint a picture of the distribution of returns in IWM over a 5-day period. All right. Now we could go down here, see a little bit more stats. If we wanted to look at just moves above or below a certain amount, let's say we took them, let's say we wanted to know, well, over a 5-day period, how frequently did the stock gain more than 6%? All right, so if we're looking at a 5-day period, how often did the stock gain more than 6%? So here we see in our observations that happen 5.5% of the time. All right. What if we wanted to see how frequently it was down more than 6%? So we could see here that happened 4% of the time. So actually 6% moves to the upside were more frequent than 6% moves to the downside, or more than 6%. Okay. Here we have the top 10 largest negative moves, top 10 biggest positive moves. So these were the dates. You could go back and look, and these were the returns. Right. So it gives you reference points to go back and look what may have happened or contributed to those moves. You do have like a histogram of the returns, cumulative distribution. And if you wanted to enter really quickly, let's say you were curious about maybe a 7.5% return up or down. How frequently did that happen? So you run this quick check. And here it returns to you the number of moves below 7.5% in the last 4 years that happened 3% of the time. Okay. The number of moves above 7.5% that happened 2% of the time. So it's a quick check, quick tool to analyze the historical return distributions in a particular stock. Okay. Now, we only have a couple minutes left, but this would be looking at all the periods. Part of analyzing data is that how you line up and group the data, right? So if you're using a model, 90% of what's important is preparing the data and the inputs, right? Because any model, you give it an input, it'll give you an output. So what's important is how you prepare the data. What question do you have? First of all, right, you have to come up with the question you're trying to answer. And what data are you putting in there that's relevant? So let's just take a look at really quickly. We have a couple minutes. Let's say, I'm trying to analyze volatility, right? Well, if I'm trying to analyze volatility, I could take all the data in the last year or 4 years and just run a straight analysis on the volatility. But then what I notice is that not all the days, not all the data is the same, right? So like and a really simple one is earnings, right? Well, we know that on earnings, we already know that the stock trades differently on those days than it does on days that you don't have earnings. It probably trades differently the day before, maybe even the day before that, and the day after, and the day after that, because there's more volume, and that trading volume is centered around this particular event. So how do you get around it? Well, when you start creating models, right? When you start creating models, you have to start separating the data out, right? So to separate the data out, you're going to have different buckets, right? You're going to have data that's going to fall into the, earnings, right? Like here. And then you have non-earnings, right? Well, how else can we analyze this data? Well, there are other things that are going on that we might want to reanalyze and put that into separate buckets, right? So let's say you have all these data points, 252 days, but then we got to go in there and really separate this data, because what are we trying to answer? Okay, and let's just do something like this, right? Let's say there's a Fed meeting, a non-Fed meeting. So you could see how right now, all the way down the line, I'm continuously separating the data into buckets, right? And all those will get analyzed differently, because I'm probably using a different model, a completely different model here than I am here. And this becomes a really big part of the puzzle, is first come up with the question, then gather the relevant data, and then we have to look for the tools and the models that could help us answer that question. So it's very important to understand that you can't just push all the data into, there is no, even if you do it in a gradient boost model, which, you can put in as many variables as you want. Still, it's how you prepare the data. What are the inputs? Because the model doesn't know what you're trying to do. It just creates an output. So it becomes very important to separate and put the relevant data first into the buckets, which for the questions you're trying to answer. And then based on the question you're trying to answer, what are the tools, what are the models that could help me answer that question?
Hey, D, we just opened. That was great. We did have, maybe really quick, Mike had asked how you got to the page, the distribution page. There was a little bit of a delay. I apologize.
Yeah. So under the stocks, right here, tools, price action analysis. If you click on that, that takes you to this page.
And Fred asked, and I'll send it over to you. We'll go over it tomorrow. He asked, on a cover call, would an implied IV be a useful back test along with the delta to compare a number of observations? I'll send that to you. Maybe we can look at that tomorrow. Great job as always, my friend. Thanks for bringing all this information to the Chameleon community live every trading day. Yep. Awesome job, my friend.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.